On May 29th, the global macroeconomic backdrop was exceptionally bullish. Major equities were surging, and markets in the US were hitting fresh all-time highs. The domestic market in India mirrored that early momentum. The Nifty 50 index started strong, briefly crossing the historic milestone of 24,000 that morning. This split-screen chart illustrates the divergence. On the left, global indices remain stable in green. But exactly at 3 o'clock, the Indian market violently decoupled. In just the final 30 minutes, the index suffered a devastating 500-point collapse. When a major domestic index collapses in a complete vacuum while the rest of the world rallies, the catalyst is rarely economic. It points to a structural breakdown within the market's own plumbing. Almost immediately, retail explanations flooded the media. The primary theory blamed the drop on sudden geopolitical tensions and fears of escalation involving Iran. However, a genuine macroeconomic threat of that scale would have registered across all global markets, rather than strictly manifesting inside the Indian market right at the closing bell. The second widespread narrative dismissed the drop as standard profit booking following the recent market rally. The sheer velocity of the downside action contradicts this. A vertical drop of this magnitude doesn't allow participants to calmly book profits. It forces them to liquidate and book massive losses. The reality is that this was a severe microstructure event. It was driven by passive index rebalancing that triggered a catastrophic liquidity vacuum. To understand what actually happened to the market that afternoon, we have to put aside the news headlines and forensically reconstruct the order flow of those final 30 minutes. The initial optimism that morning was built on positive fundamental rumors, specifically regarding potential taxation adjustments and developments in AI technology involving Wipro. This sentiment directly lifted the IT sector, pushing major constituents like Infosys up to trade 5% higher early in the session. This chart visualizes call option open interest. Notice the abnormally massive spike concentrated precisely at the 24,000 strike price. Participants built massive positions, expecting the rally to hold. This extreme concentration indicated severe complacency. Traders aggressively sold calls, confident the market would remain elevated. But as the final hour of trading began, that early fundamental optimism rapidly dissolved into deep structural anxiety across the floor. Heavy consensus positioning based on fundamental news creates a highly fragile environment. It leaves retail traders maximally vulnerable to sudden price-agnostic institutional flows. This is a minute-by-minute candlestick chart of the Nifty 50. Zooming in on the window between 14:30 and 15:30, the breakdown initiates exactly at 3 p.m. In the span of just 2 5-minute candles, the index plummeted nearly 300 points. The drag was highly concentrated. Two specific blue-chip stocks, HDFC Bank and Reliance, accounted for 90 points of the total index fall on their own. The damage was even more severe in the Bank Nifty Sector Index, where HDFC Bank and ICICI Bank were responsible for a staggering 500-point collapse. HDFC Bank, which had been trading cleanly in the green all morning, was forced down to an intraday low of 735. That level was just 10 points away from its 52-week low of 725, representing massive destruction of value from its January peak of over 1,000. When the market's most stable blue-chip stocks collapse in unison like this, it proves the presence of indiscriminate block liquidation. This is not fundamental selling. There was an unseen force executing massive, indiscriminate block orders precisely during the final minutes of the session. The mechanism driving this was an MSCI index rebalancing. When a major index like MSCI adjusts its stock weights, the passive funds tracking it operate under strict rules. They are legally mandated to buy or sell the underlying shares to match the new weights, completely regardless of the current market price. This creates critical structural friction. These index funds are forced to execute billions entirely within the closing 10 minutes of the trading day. This order book visualization shows exactly what happens next. Colossal forced selling instantly wipes out all available buy liquidity on the bid side. With no buyers left, algorithmic execution drops the price violently lower through empty space, hunting for the next available bid. Forced, time-constrained execution structurally overwrites all intraday fundamentals, creating artificial gaps and localized flash crashes. The ultimate proof that the market structure temporarily broke down is found in the derivatives pricing. This chart plots Nifty Spot against Nifty Futures. Normally, algorithmic arbitrage keeps these lines tightly coupled, with a tight variance of 10 to 20 points. In a new expiry series, participants expect a wider premium of 50 to 100 points. But on May 29th, the relationship snapped. As the spot market violently broke below the 23,500 threshold, the Nifty futures refused to follow, staying propped up above 23,700. This created an astonishing 225-point premium, right in the middle of a severe market-wide sell-off. A spread this wide proves that standard arbitrage algorithms completely failed. They either intentionally stepped aside, or they were completely, outright crushed by the sheer directional velocity of the spot liquidation. Returning to the physical floor of the National Stock Exchange puts this entire event into perspective. Weeks of carefully constructed fundamental positioning can be completely obliterated in 30 minutes by mechanical reweighting. This poses a massive danger to retail traders and option writers who ignore market microstructure and get caught opposing forced institutional flows. It also challenges the entire definition of passive investing. The sheer overwhelming size of these massive index funds makes their mandatory rebalancing highly active and deeply violent market events. As the market share of index funds continues to grow globally, these specific liquidity vacuums and arbitrage disconnects will likely become more frequent. Surviving modern markets requires looking past fundamental headlines to understand the mechanical plumbing of order execution.